All right, today we're going to be covering everything about finding real estate investors. We could probably split this up into several different videos on finding retail, doing larger deals. But here we're going to cover a lot of the basics surrounding both of those areas, and then we'll branch off a little bit more into retail investors versus higher end, more professional investors. So let's go ahead and dive on in finding real estate investors. Brief intro on myself. My name is Nikita Mangeris. I help accelerate capital raises. I am the founder of a company called Investor Ready, where we've taken a little over $4 billion in deals and investment strategies to market, helped identify the best fit investors for those, and put together all the deal packages surrounding those. We do pitch decks and a lot of other fun stuff. But I'm also part of several other companies. One is Green Street Advisory, where we focus on capital formation, specifically in the energy and energy transition space. We do a great job over there. And head of strategic advisory for Cadenwood Capital, where we do the actual process of getting people market ready, going to market, seed, Series A, much larger investment funds, things like that. So, needless to say, I am spending a lot of time in the space of doing deals and finding investors. Right. In fact, over the past 3 years, like I said, we've done almost $4 billion in deals taken to market. Those are deals, investment strategies across real estate, private equity, and energy. If we're not already connected on LinkedIn, go ahead and connect with me or give me a follow. I give away a ton of awesome free stuff like guides on pitch decks, guides on launching funds and the exact processes behind that. Spent quite a bit of time in the emerging fund manager space. We give away free private equity pitch deck templates, real estate templates, fun cheat sheets on raising your first $5 to $25 million. Great guides around raising capital, pitching investors. We do master classes pretty often. And earlier this year, we released our first ebook / guide on raising capital to 2024. And needless to say, it went pretty well. And I think people found a lot of value from that. So down to the nitty gritty details on finding real estate investors, there's a few things I want to cover in terms of the general way that we approach things, right? We've done a lot of deals. We've done a lot of investment funds, strategies, syndications, pretty much any type of real estate asset class we have interacted with, helped take to market. And there's a few commonalities across the board. So some of these foundations I want to go over first and foremost is that raising capital is a 24/7 job. This isn't when a deal comes up, all of a sudden we need to sprint and raise capital for it. Your capital raising processes should be 24/7, whether that's finding new investors, getting more people into your network, making more connections, and establishing a brand presence for yourself are really going to be key here. If you are not doing this as your 24/7 job, you need to find somebody else who is, and you need to partner with that individual, because this has to be a core part of your real estate investment firm or your real estate investment business, right? You cannot do deals without the investors to fund those deals. And so obviously, if you're doing smaller deals versus larger deals, and depending on where you're at in the journey, this is going to look slightly different. But I highly recommend partnering with people very early on that can help subsidize or completely fill this role. If you are specialized in finding the world's greatest deals, well, you need to find someone else who specializes in bringing the world's greatest, the world's greatest investors to the table, right? There has to be that balance in your approach of somebody's got to be doing this job as a 24/7 effort. Now, if you are scrambling every 30, 45 days, or every few months you have a new deal come up and you have 22 days or 2 weeks to bring that capital to the table, reach out to us, and we actually have entire investor outreach systems to help you add to the pipeline so that you don't have to worry about that. But that's a very real problem most investment deals in the real estate space face, is there's always the scramble for capital, which is completely avoidable if you set things up in the right way. We'll cover some of these foundations. The next is backyard. You have to own your backyard. So I'm based here in Utah, and one of the things that I do on a daily basis is I am on LinkedIn connecting with people in my metropolitan area. I live just outside of Salt Lake City, so I'm always looking for people in and around Salt Lake City who are in real estate, who are in lending, who are agents, brokers, who are developers, construction companies, and I'm connecting with these people. And simultaneously, since I do a lot of other deals, I'm also looking at who are venture firms in Utah? What are private equity groups in Utah? How can I research and learn more about these people? You should be spending quite a bit of time on a daily basis, even if it's just 30 to 45 minutes. This is going to be the lifeblood of your business if you really want to scale and you really want to take things to the next level, is owning your backyard and establishing that presence for yourself. And the next is the brand presence as part of the foundations. The worst thing you can do is have an amazing deal and start sending it around to people. They check you out because they don't 100% know who you are. and you have zero brand presence whatsoever. You are using your Gmail account, you don't have a website, your LinkedIn profile doesn't reflect what you do at all. And in fact, I see this a lot with real estate agents, right? Real estate agents, a lot of the time, especially if you're selling residential homes, you're going to have a brand presence for selling residential homes. Now, you may not be a real estate agent, but whatever your brand presence is, it's important to understand how that will either help or hurt your efforts in finding investors and raising capital. I highly recommend a thoughtful and deliberate established brand presence around the types of real estate deals that you do and that you're raising for, around the industry that you're in. Make it very specific and streamlined as possible. You want the investor due diligence process to be very smooth and very frictionless, right? It's very easy to lose people, especially when you're doing a lot of outreach. You're bringing a lot of new investors into your ecosystem. If you don't have an established brand presence, even simple brand assets, like I showed you on my LinkedIn profile of, hey, here is very clearly what I do, right? There's a banner photo, there's a description, there's content here in the featured section matching and reflecting exactly what it is that we focus on, right? There's links to posts, there's a lot of trails in this quote unquote brand presence that lead people to a very clear understanding of, hey, here's exactly what he does and who he helps. Establishing that brand presence is going to be a really big part of your efforts and success in scaling early on, because you likely have, if you're in the real estate space, you've likely done small deals with accredited investors, 50K, 25K, maybe even $100,000 checks, and you're looking to scale a little bit beyond that. So today we're going to go over a few different very real world scenarios. One was a medical office fund that we did last year. The next is a commercial real estate acquisition in the city of Phoenix, Arizona. It's just outside of it, which was a $12 million equity raise. The fund was a $100 million equity raise. We're going to cover some of the specifics and exactly how we found those investors. But first, I want to make this delineation. I mentioned this a little bit earlier of retail versus professional. There's a lot of ways to classify investors, right? There's the SEC classifications of accredited, qualified purchaser, qualified client, things like that. I'm not talking about the SEC classifications. I'm talking specifically about people who are very much considered retail investors versus people who are going to be more along the professional investor side of things, either as a part-time or a full-time focus, if they have enough capital that they are actively trying to manage and grow it, whether that's through themselves and their own efforts, whether that's through a family office, right? Whether this is through a fund managing and allocating other people's capital professionally, wealth advisors. There's a lot of people who fall in the professional space. Just as kind of a rule of thumb, if they're not retail and they're investing in real estate, they're likely more of a professional investor, right? This is their full-time focus, their full-time effort. You're going to need to be a little bit more buttoned up. These are likely larger check sizes, more high-value partnerships, right? If you're wondering how people raise $100 million plus, even $50 or $20 million funds, you're going to need much more people in the professional, quote-unquote, investors category here. And just to kind of hint a little bit more and go through some of the specifics, I break it up into 3 different categories. To step back, the reason I'm going over this, and it's so important to understand, is because you cannot find investors if you don't know who you're going after. And so everybody's default, usually, especially in the real estate space, is to try and get more smaller checks. You're going to real estate meetups, you're calling friends and family, you're asking for referrals, you're reaching out to people like me saying, hey, we would love to partner with you and have you do all the capital raising for our deals. And in reality, that just does not work. Now, the reason we get so many deals done and taken to market and find the right investors for them is because we understand exactly who we are going after. We understand what these people want. We understand what we are offering in relation to what these people want. We see things through their lens, right? Depending on how you're structuring deals, if you're looking for passive investment partners, if you're looking for joint investment partners, if you're looking for active partners in the GP to help you out, there's very different approaches for all of those things. But I always start with how we identify investors, which is I classify it into 3 areas: institutional, professional. Both of these are kind of the professional category that I was talking about, right? Because they're not retail. And the accredited investor category, which is the retail. Now, a lot of people say, oh my gosh, there's 25 plus million people. There's, X tens of millions of people in the United States with a net worth over $1 million. However many people fall into this category, they look at this and see a huge market potential for raising capital. Well, the problem is accredited investors likely and always are going to have the least amount of capital available compared to these other 2 categories, right? I have a lot of these bar charts to help you visualize a little bit more. Each of these categories, what is their total resources available to vet and do deals? What is their total capital available, right? The people who have the most capital available also likely have the least amount of time available, whereas the People with the least amount of capital are always going to have the most amount of time, right? That's true across any business and any sort of customer demographic, if you will. Resources available, sophistication level, accredited / retail investors are going to be the least sophisticated, which is why you see so many real estate syndicators going after retail investors with egregious terms and their deals and syndications, right? They're offering, guaranteeing right a 15% pref or 10% pref and 50-50 splits, all these buzzwords to make their deals sound really good and really secure. When in reality, the deals just are not that great, or else they would be going after more sophisticated investor classes. And so one of the things that I like to focus on is how can we raise the sophistication level of the deals we're doing to go after better fit investors for us, to allow us to do more deals, larger check sizes, to get deals done quicker, and to scale the vehicle that we're doing them in, right? If you only have buckets of a few $1 million worth of retail investors, it's going to be very hard to launch a fund if you want to go down that route, because likely those same people are not going to want to invest in a fund, right? That's an entirely different story, but a fund is a very different product than just going deal by deal. But regardless, you're going to need to start to scale into the more professional institutional level of investment partners during this process, which means understanding exactly who these people are, what they want, what are they underwriting, how active are they in the space, how much time do they have, right? Time is a huge factor in knowing how you need to start to approach these people, how you need to outreach, how you need to find and potentially identify. Is it through partners? Is it through direct outreach, right? You need to understand their sophistication level in relationship to the sophistication level of your deals. How unique are the deals that you're really doing, right? We're talking a lot about deals and the quality of your deals when you thought we were talking about finding investors, but really finding investors entirely hinges on your deals, the types of investors you're identifying and going after, and your ability to find alignment between those two categories, right? You either need to find alignment or create alignment. If there's one thing you take away from this on finding investors, you either need to find alignment, meaning there's people out there already looking for what you're doing, or you need to create alignment, meaning maybe you need to bridge some gaps. Maybe there's a little bit more education required. Anytime you're going along lines of creating alignment, you're likely going after less sophisticated investors, right? If you're convincing someone to do something, you're likely going after less sophisticated investors, because institutional investors and professional investors, their number one priority is not cash flow, and it is not wealth creation, and it is not a preferred return against collateralized assets or some multifamily building, whatever it is. They do not have the same priorities, right? And so if your deals don't match up with that, it doesn't matter. You can find investors all day long. However, you're not going to be able to actually convert them into your deal or fund or syndication or whatever it is. So always understand you either need to find alignment or create alignment. In order to do that, first, you have to take a really honest look at the deals you're doing and the types of investors that you're going after. Quick break. Once again, if you need help going to market, please let us know. Reach out to us, schedule a call. We do all sorts of stuff from decks to identifying investors, helping you pitch, putting together investor outreach systems, whatever it is. We support capital raises, make them go a lot faster. So back to institutional, professional versus accredited investors. Once you identify exactly who you're going after, it's also important to keep in mind, once again, if you're doing demand generation, which is what I talked to a little bit of, are you creating demand for this investment product, right? Or are you capturing demand? Demand generation versus demand capture are two very different things, and you have to understand them if you're looking at finding investors, and especially finding best fit investors. I see too many people who spend 6 months, 12 months, 18 months on the same deal or thesis, raising exactly $0 because they don't understand this specific area, right? They're trying to create demand among retail investors for their larger deals. But the problem is retail investors likely only have 50K or 100K checks, maybe 200K or 250 if you're going after dentists or lawyers or people in the medical professional space. They need a lot of education. You can really only get to them at scale through some level of paid advertising or paid growth, right? You're paying to be a speaker. You're paying to advertise your book. You're paying to advertise directly to these people with your deals, right? Creating demand is always going to cost a lot of time and money in relationship to the amount of results that you get from it, because you're on the demand generation side. Your area of focus as a GP or syndicator, even if you're doing smaller deals, larger deals, I always recommend shifting away from retail, going more towards ultra high net worths, funds, family offices, and institutions. Your area of focus should be right around here, which means you're not quite all the way over to the right of demand capture, There's still a little bit of demand you're creating, but you're more or less meeting checklists of certain requirements, right? You are meeting the checklists of requirements. And I think I say this maybe here. You need to generate demand for yourself and your firm, which is why I talk about brand presence, having a lot of these things in place while capturing demand for your deal, right? You cannot convince an endowment, you cannot convince a REIT, a large real estate fund, to invest in your project if they do not have a thesis for it. And specifically, if they do not have a thesis for investing in the specific way they want to invest, right? Maybe you are trying to attract LPs or limited partners where you're only talking to people who only invest as JVs. They only invest in joint ventures. They only come in as co-GPs, right? You have to understand what their preferences are and exactly who you're going after and identify these things very early on and decide, hey, is your priority to get deals done, to get things over the line and to scale, or is your priority to get this deal done in this specific way and to, get your acquisition fees and your carry and your management fees on the specific deal? But understanding your area of focus is going to be key here in knowing, do you have to create demand or are you capturing demand? And most of the time, the more sophisticated your investors are, the more sophisticated your deals are, the more likely you are to be capturing demand and meeting a checklist of requirements, which then means you have to be going to market very prepared and ready and knowing exactly who you're going after, who you're identifying, where these people are, and what you need to have ready for these people. So we've talked about a lot of stuff that's not exactly finding real estate investors, but these are the foundations that we always go through, put in place in terms of getting ready, knowing who exactly we're going to be going after to make this entire process very easy, right? If you spend an hour sharpening the axe, or if you have 3 hours to cut down a tree, spend 2 hours sharpening the axe, which is really the most effective approach here. If you have the sharpest axe possible, if you have the best prep possible before going to market and before going down this path, everything else becomes a lot easier. So our process, like I kind of alluded to in finding investors, like I said, first investor alignment, understanding what your incentives are as a syndicator or GP, understanding what investors' incentives are. Trick question, do you have the same incentives? No, you don't. And you view the capital that's being invested very differently. If you are the active manager or investor in this deal, right? You're raising money from investors, you're doing your value add strategy, your land development, your mixed use development, whatever it is, you are compensated very differently and you make money very differently as opposed to how investors make money. So you have to understand those differences. You have to understand their desire to preserve capital most of the time is greater than their desire for cash flow and upside and all these things that a lot of people talk about. You have to understand where else they could be putting their money for less risk and higher returns, or less risk and lower returns, and really understanding the balances of what it is that you have to offer. You have to understand intermediary incentives, right? If, like I said earlier, you're going after partners and raising capital isn't your main focus, it needs to be somebody's, you have to understand their incentives. And I'm not talking about compensation and paying commissions and anything like that. I'm talking about social capital, right? Anytime you reach out to somebody else to help assist you in the process of raising money or finding investors, you need to understand what they are underwriting, right? If somebody reaches out to me and says, hey, I've got this awesome deal, can you take a look at it? The number one thing that I'm thinking of is, am I going to look stupid putting this in front of my network? How much time is going to be required of myself to understand this enough to know if this is a really good deal to put in front of somebody else? Is this even worth my time? Am I building social capital by doing this? Am I doing a favor, right? Understanding all these things in the middle and with these intermediaries are going to help speed this up along a lot. And then the types of investors, like I said, you really need to double down on what you're going after. If you're going after retail investors, you need to go after retail investors and really make that your business model. But that's a very different business model than, somebody like Bridge Investment Group, a very large family of real estate funds and private credit funds who only go after very large check writers. You will notice commonalities once you get to larger and larger levels of capital of these very large real estate funds. They're only going after the highest sophistication of investors, right? They're going after the endowments. They're going after the multifamily offices. They're going after 10, 20, 30 plus $1 million checks at a time. And investors are actually trending towards that as well. The more professional investors are now really looking to allocate in more concentrated numbers to a fewer amount of fund managers. Now, this is especially true in other industries, but it's starting to be more true in the real estate industry as well. So understanding what these investors are looking for, where they're at, and what they're wanting is crucial to being able to find that. Now, preparation, I haven't talked about this quite as much, but you have to be prepared, right? Before you start finding potential investors, have your stuff together. Understand exactly what it is that you're offering. understanding your offer, understanding the strength of your offer, understanding how your offer compares. This is one of the biggest things that a lot of people miss out on is they don't realize how unmarket friendly their terms are. Right? When you're branching from your warm network, let's say you've done a few $1 million in deals over the past few years, or maybe you do $2 to $3 million in deals per year, and you're using a lot of the same pool of retail investors or accredited investors, right? You may not have accurate feedback on on how your deal compares to other deals because these people are probably only investing in you. So you have to get feedback from people who are investing in a lot of deals and who do actually understand the competition. You see a lot of people come to me and they're very set in their one single type of deal structure. I was talking to a group the other day doing multifamily value add acquisitions. They're also buying stabilized assets, doing core plus, but for the most part, they're doing multifamily deals about $5 million range of acquisition price. Total equity raised for these 15 to $20 million acquisitions that they're going after, and they're looking to expand their fundraising efforts, going after larger investors, more sophisticated investors, larger check sizes, because right now they have a pool of investors that they found that they've been able to tap into, which is awesome, who are okay with their current terms. And their current terms are a 10% flat rate of return guaranteed. Right? You get a 10% return on your money. We keep all the upside is essentially what they're offering. And I told them, I said, hey, those are really not market terms. So what else are you doing to justify that? Do you guys have an incredibly lower amount of risk that you're bringing to the table? Right? What is it that you're doing to justify these terms that are not market whatsoever? Right? Because corporate bonds, what is the rate of corporate bonds, and how do those returns compare to what you guys are offering? Right? There's so many different things to contrast this with that these more sophisticated investors are thinking about. So we have to learn to start to think like them if we're going to know if what we're doing is going to work or not. And their answer was essentially that, in my words, that they're not really doing anything different, right? They have the same risk profile as the rest of the market. They have a lot less experience than most of the market, yet they're offering terms to people that are highly skewed in their favor and are not in line with market terms. If you want to get familiar with market terms, just keep in mind 80-20, that if the more people differ from an 80-20 type of offering, the less likely you are to find more and more sophisticated investors, right? So if you want to go down that route and you want to spend less time on investor education and convincing people to invest in you and why it's a good deal for their retirement and retire early and get cash flow and all these, whatever buzzwords people are using with the retail and accredited investors, you have to go more towards market terms, which means you have to look at what you do in a bigger picture, right? The bigger picture for you, and you really need to decide, is long-term, do you want to be making a few $100,000, a few $1,000,000 a year through acquisition fees, through your upside and selling deals? Do you want to be making your money as a money manager, right? These are very different things which people don't really understand the nuances. If you're launching a fund, you are now a money manager, right? You are responsible for managing and allocating capital, right? That's how you make your money, which is with management fees, maybe some acquisition fees, your carried interest and upside. Do you have the reserves to be able to handle that? If that's different than your current structure and the money you're making right now, do you have enough to be able to transition? Do you want to transition, right? So you have to start thinking of all these things of how are you incentivized? How do you make money? Does that fit in with what you're offering? Is it okay to go after these types of investors? Is there that alignment there, which is that favorite word that I brought up earlier, is creating that alignment, right? Between what you offer, who these people are and what they're looking for, and how much alignment is actually there. A lot of what we spend time on, which I'm going through right now, is the process of creating alignment in order to even find the right investors in the first place. A lot of people come to me and they just say, hey, help us identify all these investors, or who do you know who would invest in this deal? And I usually say, honestly, I know a lot of people who invest in real estate. I don't know anyone who would invest in real estate in you because I don't really know you yet. And none of my investors know you yet. I don't know how much alignment is there. I don't know what you're offering. I don't know the risk profile that you're bringing to the table, right? There's so many factors at play in creating that alignment. Just spend some time doing it, and it makes the whole process a lot easier. So prep, offer, the strength of your offer, how your offer compares, and then having the right materials put together. So many people say now, especially, oh, pitch decks don't raise money. Name me one scenario where pitch decks have not raised money, right? And a lot of the time it is with very intimate, familiar connections and relationships. If you're going to warm markets, you are likely going to need a pitch deck, even if it's not for your end investors, right? Maybe you're one of those people, founders, operators who just tells an incredible story, pulls people right into the due diligence phase, where they just want to look at numbers and pro forma and some of those things in that step. But even if you're not, like I said, going after those people with the pitch deck, you still need a pitch deck for intermediaries. Non-investors play an incredibly critical role in your capital raising efforts. In fact, I talked about this the other day, which is, non-investors, everyone who's not going to be investing in your deal, these are friends, family, active investors that maybe aren't a good fit. These are, well-connected people, whatever it is. They play a very crucial role, and they are underwriting something very different than the end investor is, right? Like I said earlier, when someone reaches out to me, I'm thinking, hey, am I going to look stupid? Am I going to waste my time? Is this valuable to my network? What do I get out of this? Understanding these things and having the right materials together actually makes working with intermediaries a lot easier, right? The worst thing you can do is reach out to someone and say, hey, do you have any investors for a $4 million equity check in this, national brand grocery real estate deal over on the other side of the country? And I say, can you send me any information? And they say, well, we don't really have any. Great, then there's absolutely nothing I can do to help you. Probably twice or three times a month, I get someone reaching out saying, hey, do you have investors for blank? I say, yes, can you send me any info? And they usually don't have anything. In fact, 2 to 3 times a month, they don't have anything in place whatsoever. And there's absolutely nothing I can do to help them. When you have the right materials together and prepped, now imagine they have a beautiful pitch deck that very clearly explains what they're doing. If I'm familiar with real estate, I can see the value in it right away and say, oh my gosh, this is a good deal, right? Having these decks and things built in a way where you can work with intermediaries makes this whole process move a lot quicker and helps you expand your networks a lot easier. Like I'm talking about earlier, when it comes to raising capital, it's a 24/7 job. You're constantly having to find new potential partners, new potential capital sources, connections to capital sources. And the best way to nurture and create those connections is with the right materials and the right approach. Anyway, I digress. And then the next thing you need to start thinking about is outreach. Softwares you need, outreach channels, optimizing outreach. We actually offer completely done for you investor outreach channels established for more sophisticated investor types, right? Specifically for larger institutions, professional investors. This is not retail approach. We do entire, systems of targeted finding specific investor avatars, specific groups that are active in this space, doing outreach to them. But first, that's all going to start with owning your backyard. I'll talk more about that later because we want to get into the specifics of the deals exactly, which we'll start to get into. But understanding outreach can be a really powerful tool in this entire process if you're utilizing it correctly and if you have the right foundations in place. So let's dive in to some of these case study examples of specifically the $100 million medical office fund, which I think you guys will find pretty interesting. And then this $12 million acquisition deal. I could go through dozens and dozens of different types of deals that we've done, but really the foundations are all the same, which is as you start to change how you think about finding investors, who these people are and what they want, the rest of this process becomes very, very cut and dry. It's not a matter of, oh, hey, go to pitchbook.com and sign up for their membership, or go to Dakota Marketplace and download their investor lists. It's really not that. And the people who think that it is are likely people who think their deals are good enough to get to that level. But I would just suggest, if you think that's you and you think the only thing you need is to get in front of more investors, I would just ask why you haven't gotten in front of more investors already, right? Why that hasn't been a focus, or if it has, why you haven't found success doing that. And if it truly does come down to the fact that everything is 100% buttoned up and all you need is a list of people to call and you can start dialing, great. We can probably help with that. And it's really easy to find active real estate investors online, right? Most things are relatively free or cheap nowadays. Now we have proprietary investor databases that we've built for ourselves and for some of our clients that work really well. But that's really just the last 10% factor in any effort to find investors. So for the medical office building, $100 million raise, this was in a fund. It was also, prior to the fund, a series of syndications, right? We see that nice familiar path of scaling, which is usually going from a few syndications to launching a larger fund, small fund, medium fund, then to a large fund, whatever that path may be. In this case, there was a very experienced syndicator who had been doing quite a bit of deals. And what we ended up doing was going through this exact phase of, hey, investor alignment, who are we really going after? Do we want people who are actively investing in real estate? Do we want people who are actively investing in real estate as limited partners specifically, meaning they are expecting to be a passive investor, right? Passive investor expectations are very different than active investor expectations because they're underwriting very different things. And so we knew here that if we're going after very passive investors, or sorry, very active investors, then they're going to want to have control over a lot of the deal. Well, we had a really great national level development partner that we were already working with, which was a big factor here. So we didn't really need more active investors. I'm going to put national dev partner here. It's really key, right? The more credibility you can bring to your deal and strategic partnerships, names at the table, that's always going to help a lot more. And then what we did is we approached different investment banks. So we went the IB route and we said, hey, we have a budget of about 200 grand to get this raised done. You see, you as a GP need to be thinking about how you are investing into your own deal. And sometimes that's directly investing into your deal, which most deals or funds are going to require you to do anyway. The more sophisticated investors you go after, 5%, 3%, 10% is usually pretty standard, somewhere in that range. However, you also need to be thinking about how much capital you have available to invest into getting the deal done. So I'm going to say to get the deal done. How much money do you have available? What is your budget? Because you need to think about, hey, if you do $100 million raise, that's X amount of acquisitions. How much is that in acquisition fees? Well, worst case scenario, that's at least $1 million in acquisition fees. How much is this in management fees? What is this in carry plus upside, right? If you can spend 200 grand, and this is just how I think about it, and I'm not saying you have to, you definitely don't. And I'll share exactly what didn't work in this case, and we actually lost a lot of money. But if you can spend 200 grand to get $10 million or $15 million in fees and upside over the next 5 years or over the next 7 years, that's probably worth it to you as the principal or as the manager or as the syndicator there, right? So we went down the investment bank route. We paid one investment bank $150K. Very qualified. They've done over $10 billion in transactions, and we got exactly $0 raised in return. Still to this day, I think they, reach out to us and let us know, hey, we're still floating this deal around, or hey, we've got some interest here. It's a bunch of crap. And the reason it is a bunch of crap is because this was a few years back. We didn't really know what we were doing in terms of their capabilities. We were just a little bit more blindly trusting. Is when, 2021, 2022, there was a lot of capital in the economy, right? We thought it was going to be really easy to raise money. Oh, we'll just pay these guys. They have a really long track record. It got exactly $0 raised in return because they didn't go through this process. They just thought, they said, hey, we've got a big Rolodex of companies. We know how to get X deals done. But they didn't realize that they didn't know how to get X deals done with specific X type of team, right? There's so many different factors when it comes to who can you pay to raise money for you. Yes, they're licensed broker dealers, so we could legally pay them. However, they didn't really know how to raise money for the specific type of deal in this area with this specific type of team and all these set of factors, right? They didn't really have that true investor alignment there. We wasted a lot of time. We wasted a lot of money. However, what we did next was very interesting, which we started to go after strategic partnerships, right? Who knows the people we want to go after? Well, we started to realize that there's probably a lot of family offices who are investing heavily into real estate. And these family offices, if they don't have an internal team, they have an external team, or they have an outsourced team, or they have preferred partners that they like to work with. So we started to think, who provides deals and analysis for FOs? Well, what we did is we then identified two different individuals who were each able to commit to bringing about $40, $50 million to the table. So then all of a sudden we started to have some traction, right? These were individuals who had previously brought several $100 million in deals, in capital to the table for very similar deals. That's very key. For very similar teams, that's also key, from their specific connections, which is also key. And we started to explore different collaborations and different partnerships with these individuals. So we found two different individuals in that range. We found three with this same frame of mind. We found three different PE firms who were the perfect fit, and each were bringing 10 million, to about 20 million to the table. Various amounts for various PE firms. Because we realized that these people were managing the wealth of a lot of these similar types of people, right? People who want to be passive real estate investors, guys who had a lot of credibility with their investors, guys who were acting kind of like a fund in that they're allocating, they're vetting, they're doing analysis, they're bringing deals to the table, right? They're helping these people invest. And we started to realize that there was a lot of success in these small boutique PE firms, right? Sometimes PE firms will position themselves as wealth managers, right? You can't just Google, hey, PE firms near me. Sometimes it's wealth managers. Really dig into exactly what they offer. Start to understand, are these people allocating capital? Are these people actively looking for investments? These people are probably really good people to know and to partner up with or to outreach, right? Like I said, own your backyard. Start to get a lot of these connections in your pocket, because as you get connections and as you have really good deals, well, guess what? People love to share amazing things. Intermediaries can absolutely act in your favor. Non-investors can play a huge role in that. If they do see something really valuable, anytime I see something incredibly valuable, I want to share it right away, and I want to get this out to as many people as possible. So potentially look for wealth managers, right? PE firms, PE groups, right? A lot of these different things. But these are the people that we brought to the table. And it took us about 8 months, I think about 7 or 8 months, to realize that this $150,000 was completely lost. And in the following 4 or 5 months, we were able to bring all these individuals to the table for that raise. Now, this was a long process. Like I said, this in total took about 12 months. The prep time alone was about 2 months of meeting once a week, twice a week, really making sure we had everything together, right? Because if you're going down this route, you need to have the models in place, you need to have decks in place, the stories. You need to be thinking of questions and risk factors that your investors are going to be considering and preparing all those beforehand, right? We do pitch decks, financial models, FAQ sheets, risk management question and answers. We're really going through the nitty gritty of confronting the hard questions head on. And what are people really underwriting? Is, are these guys going to lose me money? And so we need to think of all the ways that they're considering how their money could be lost, right? But finding these investors at this point was entirely through our personal networks. We knew people who knew people. And because we had everything together, it was very easy then to get in front of people who knew and worked with family offices, right? Because our value proposition to them is saying, hey, we're looking for long-term partners who can really help us grow and scale, and bring more relationships to the table. We think we have a really good deal. Are you open to new partnerships that have really good deals and really good strategies, right? You have to let your deal carry a lot of the weight here. That's what we did, and it worked really well because we had gone through the process of really prepping and making things as good as possible, specifically for these type of people to think, okay, I'm not going to lose social credibility by bringing this to the table. Okay, I'm not going to waste anybody's time by putting this in front of different groups, right? That's really the mindset that you have to think of when you're going through networks. So we went through personal networks. These are the firms we ended up with. Like I said, it took about 12 months in total. There was dozens of more conversations along the lines that we had here with construction companies. I'll just list who else we talked to. We talked to construction companies. Oh, if I can spell construction. Who were consistently looking for 1031 placement, because our deals made a lot of sense for 1031 buyers or 1031 exchange coming in as a sidecar, different things like that. We spoke with a lot of ultra high net worths. Early on, we brought team members to the table who had a lot of connections, who wanted to get into the space of doing larger real estate deals. And we said, hey, part of your responsibility is, if you can come to the table, help us formulate what you think will be a really good product for your networks. And we would love for you, as part of your responsibilities, to just bring as many people in your network and show this to them, right? Come be a general partner with us, partner up, and let's, outline these responsibilities. This wasn't, hey, we're finding people to pay commissions behind the table or under the table. Can't really do that. You have to do what's legal, which a lot of times is going to be, a partnership, a general partner approach. And getting access to these ultra high net worths really only came through, once again, personal networks. Personal networks are really going to be key. It's either going to be your personal networks or somebody else's personal networks, intros of intros. Because when you have something really good, like I said, it likes to spread. So we talked to ultra high net worths. These are people who had exited SaaS companies. They had exited manufacturing. And then there was one gentleman who exited a franchise business. He was a franchise for FedEx, right? These are older people. These are every one of these guys was 55 plus, retired, happily investing a few $1 million at a time here and there. Got in front of a lot of them, and we didn't see a lot of success because we realized that the strategy wasn't the best fit for them, because they are very, risk adverse. They don't need to be investing. A lot of people, contrary to popular belief, do not need to invest in syndications or real estate funds. A lot of people have tens of millions of dollars if they're an ultra high net worth, 100 million plus, and they don't care to invest it. You'll find a shocking amount of people in your backyard and local areas of people who have a very high net worth who don't ever care to invest a penny in. And some people go down the route of trying to educate them and trying to get them to the table and whining and dining and schmoozing and golfing and all these things when it's really a waste of time because there's other groups who are actively investing in this. So when you realize that, it's usually less pain and less of an effort just to go after the groups who are actively doing it, right? This entirely comes back to demand generation versus demand capture, where your area of focus is. A lot of times, the reason I put ultra high net worths here is because sometimes you really do need to create demand because these guys are not actively investing as much as you think they are. If you're trying to get into the highest country clubs or golf clubs or, whatever clubs in your local area that you think these guys are in, thinking that they're going to invest a lot of money, they don't have to. They know how to create it. If they're a successful exited business owner, they know how to create money. They know how to create a lot of value for themselves. And so you're probably better off going after funds, family offices, and institutions, investment groups, things like that. Just, kind of little side note there. Now, going into the next case study, which is a Phoenix acquisition. So the total amount of capital needed, this was a $60 million acquisition. If I can spell this morning. There was $30 million in equity needed. The remaining $30 million was coming in bridge financing. We had another general partner who was bringing $18 million to the table. So our portion of the general partnership, we were responsible for bringing $12 million to the table. And exactly what we did here is first we created really good teasers for the property. We created a really good story and a really good business plan. Because Phoenix is close to our market in Salt Lake, what we started doing is taking people down. One of our partners had a jet. We were taking people down to Phoenix most weekends to show them the property. And the thing was, we weren't positioning this as a, hey, come with us so we can pitch you this property that we're raising money for. It was, hey, come down to Phoenix with us. We've got a few business meetings. Welcome to tag along. We'd love to spend time with you for a day or two. If you just want a quick day trip, right? Because we're friends. We know each other. We want to spend time together. We're taking people down to the property to show them. And then what we would do is we would walk them through the vision, right? Here's what we're planning. We're going to do a ground level restaurant right here. It was a great location right off Main Street where there wasn't really a lot of other things going on. This was an office building. There was maybe 20% occupancy. There was a bank inside, and that was one of the only active tenants. The entire third floor was completely empty. This is 140,000 square feet on one building, 160,000 square feet on another building. There's a lot of empty space here, right? This isn't the best, thing to just go showcase in terms of what it is. But it is a really good thing to showcase in terms of what it could be. We're just walking through the vision, right? Hey, we're going to do a restaurant here. Above the restaurant on this level, we're going to do, some sort of nightclub, bar, speakeasy, whatever it was, and just walking through a few different aspects. We've got this potential tenant wants to move in. We've got this really big name, is a huge podcaster, wants to bring a studio here, right? Start to just walk them through the vision. And what that led to intros. Because all of a sudden these people, they want to help, especially when these are, people in your network. They start thinking and they start to see the reality of it. They know that you've thought this through. They know that you're prepared, right? This is why I go through preparation, especially with intermediaries, is once you're prepared, people are willing to do a lot more for you because they know you have your stuff together. They know that you know what you're talking about. They know that they're not going to be wasting time for people in their network. But that led to other introductions of like, hey, you should really talk to so-and-so, or hey, so-and-so has a restaurant that I think would be a really good fit here. You should talk to him about opening up a new branch here. He's crushing it up there. This type of vibe would work really well here. And guess what? That restaurant owner had a lot of capital sources that he had gone to in the past for other locations that he'd done. All of a sudden, he's able to bring those to the table, right? Because if he's bringing the restaurant, he also now wants to look at it as, hey, I can actually own part of the building and own a lot of these other things. Oh, by the way, I know who can be upstairs. Right? We can actually launch a new brand, or hey, a partner company of mine can be the nightclub bar on the upstairs level. Well, I could be the steakhouse or whatever it is, right? You start to bring more people to the table once you walk them through the vision. When you have something good together, that's going to lead to other intros, right? So the number one thing here, right? I know you're looking for tangible ways. How can I find investors for this one deal? Is you've got to give yourself enough of a timeline to make it work. I'm just going to put time. The number one thing that people do to shoot themselves in the foot is they do not give themselves enough time to make the magic happen, right? When you're struggling and rushing to find investors on a 2-week or 3-week deal or a 4-week or 5-week deal, it's a very different story as opposed to, hey, we've got 3 months. Hey, we've got 2.5 months. We've got 6 months, whatever it is. We've got some earnest money in the deal. We're holding it. We've already done initial closing. Whatever it is, focus on buying yourself enough as much time as possible, because that's when, like I said, the magic starts to happen. Connections start to be made, right? Things are not going to pass through a warm network overnight, right? It is very hard, if not impossible, to raise money overnight. It just cannot be done, right? Especially the larger and larger amounts of money, the more due diligence that's going to have to be done on this. If we go back to pull up this investor profile, right? Capital available is really high, time available is really low. Do you think people with low amount of time available are going to be able to invest like that? No, absolutely not, right? They have very low risk tolerance. They have very high amounts of due diligence that are needed. Now, people will then say, hey, well, don't you know anybody who's a high net worth, who's got a lot of money? Well, once again, most of these guys don't need to be investing in this, and they're not going to be investing in something outside of their expertise. And so you have to be going after the right investor with the right timeline, with the right amount of alignment. Time is this last factor here that's really going to make or break all deals. You see, most syndicators and capital raisers run out of time, not investors, before they reach their target raise. In fact, that is the main phrase on our website. If you're raising capital, speed is number one priority. You'll run out of time, not investors, before you reach your target raise. That's why we do raise money faster, by building the right foundations. That's why a lot of what we've gone through today is building the right foundations. Guys, if you've had value from this and this is making sense and you're like, oh my gosh, I'm grateful for this time that I spent listening to Nikita. Hopefully you listen to on 2X. There's only 25 minutes or so. If you found value from this, I would just ask you to do one thing for me, which is consider which areas of your business or capital raising efforts may need some help. And we want to offer you, I want to give you an hour of my time. Book a call with me, reach out to me, send me a DM. I'll put my calendar link in the description of this video as well. And let us help you with your go-to-market strategy. Let us help you talk through some of these things for your deal specifically. Like, hey, you're likely going to be wanting to go after, these types of investors. In order to do that, based on what you guys have, you probably need to put X, Y, and Z together, because we put together really cool stuff for capital raises. We do investor outreach systems done for you with guaranteed number of meetings. We do the world's best pitch decks, financial models, due diligence materials, all the stuff that you need to really get going and to get traction. We do all of that. So once again, if you found value from this, I want to give you an hour of my time. This is what I do. I invest my time. I invest money, and I invest time, and I invest time in finding the right deals for us specifically, right? We are always looking for more deals to take to market. And that's why we offer a lot of auxiliary services to help these types of deals get more investors, education around finding investors and putting the right materials in place. So if that sounds like you, go ahead and book a call. Thank you for watching, and we'll talk again real soon.